strong customer base of yours, the corporate or the wholesale part of it, is today getting out of the picture.
I get to know these are the days you spend a lot of time on YouTube, lot of time, even in office, and particularly you watch on some truckers blog. I mean, what is happening? What is, I mean, YouTube, I can imagine some entertainment, but truckers blog, it's some size, some investigative agencies and all, some other job beyond Geo. What is it, sir?
Yeah. Tamal always pulls my leg, so and he's not changed all these years. No, I use YouTube as an educational tool.
Oh, okay.
So it satisfies my curiosity to learn. So I look at a trucker's blog to see what's happening across India. Where all can we reach in what time? What progress is happening along the road? What's happening at the state level across India? And I think I'm a better informed person. So that's only one part of it. On any new topic that you today you are curious and want to learn something, probably a simple YouTube search gives you next 2 days of education. So I keep myself engaged.
Oh, that's the key to your.
So you can say it's an educational tool.
Okay. Mr. Kamath, so getting you, I think it's an opportunity to discuss beyond banking, the larger macroeconomic scenario, what's happening and all. So tell me one thing, what we, the observers, in a very limited way are seeing that is a sort of confluence, banks, NBFCs, mutual funds, everything. We have never seen that kind of thing. So there are multiple interpretations, what's happening, financialization, etc., etc. Household money is going to mutual fund through SIPs and all. Corporate money again is going to mutual fund, the liquid funds, etc. Then there are arbitrage funds, you get tax advantage. And everything, technology is making it possible. So the funds flow, which was earlier, from a mountain, it just goes down, like money flows down and all. It's no more the thing. There is so many channels, so many things are happening and all. And all these things are putting pressure on banks. We are discussing with Mr. Sethi also. So what's happening actually in that front?
Yeah, I think what you observed is clearly happening. So we need to understand why is that happening. You mentioned one point, technology. Technology has made things seamless. So your financial savings can now move into various forms of, say, investments, and back to saving, back to consumption, and so on, in a seamless manner. So if that is so, then you ask a question. Is a bank the only structure under which this can be done? And I'm not asking that question. That question is being asked by the lay person in India. And the lay person in India then is saying, I'll deploy my savings into products, it could be investment products, which give me, on a risk-adjusted basis, the highest return. And it could be risk and tax-adjusted basis, the highest return. So that informed Indian today is moving his or her money. And as I see it, this is just the start of it. Because you would have seen that this process has actually started gaining some momentum only 4 or 5 years back. Along with that, there are 2 or 3 other what I call structural enablers that have come up. You now have a well-established pension system. You now have a well-established insurance system. And of course, the mutual fund industry itself. So you need to look at what I call the capital market as something which is operating in parallel to the banking system, and the consumer has choice. And technology has enabled that seamless movement from one market to the other.
We'll come to the technology later. So banking, I think in Indian context, there are 3 things about. One is on the left side of the balance sheet, that's the liability, the money that we discussed and all. On the other side, the right side, which is the assets. And the other part is the fee income. Now, if you look at the banking industry's balance sheets, everything, most of these cases of the fee income is just going down because UPI, just what the money was actually they are charging and all, now UPI is free, everything is free and all. The float is vanished. And bankers are just, I think, haplessly watching it Are they doing anything, or is there anything can be done? Because in private, they all, I mean, they say that what's happening, why are we not charging, etc., etc., and they're losing their fee income, but they're doing nothing. Is that they can't do anything, or what?
No, answer is not only UPI, there are other things which will also cut into their fees. Actually, there are things which are cutting into their fees even before UPI. It's now only accelerated the whole process. So take for example, you were enjoying a free float every time a check went for clearance. So that vanished.
Absolutely.
Then you were enjoying a free float, of course, on overnight money that you had no option but to keep in a bank as CA, the current part of it. And the lay customer would put the SA part of it, the savings part of it. Now both of these...
and the government money. And the government money also is lying
So now
idle.
everybody can move this into something which earns you a return. The CA was interest free. So you can put it in an overnight fund where you will earn interest. So basically the person who is dealing with the institution now has more options to deal with the institution in a manner that is, in his interest and is profitable. The banks then need to figure out if this is so, is there a change required for the operating model? So it is not just superficial corrections, because the model has already changed. So your core model has to now change. So I think that is a question that banks ought to ask. Luckily, I am not there anywhere in a bank, so I don't have to ask that question myself.
No, but you are raising that issue. How does, there are bankers sitting here and all, from your experience, and which is such large and such varied and all, how would they change the core model?
Yeah, but before I answer that question, let me push the agenda so that then I can give a comprehensive answer. So it's not only on the fee income that there is a change, and this change will get even, I would say, go deeper. But one will have to also look at, has the profile of my customer changed? Because when I started my banking career in 1971, development banking career, everybody, every client of mine, the working capital came from a bank. And that was like permanent capital, that was permanent business for the bank. Now that is slowly going away, at least as far as the large companies are concerned. They use working capital borrowings very opportunistically. They don't use it as it's always there 100% of the time. So they use it opportunistically, and as their balance sheets have become cleaner, as cash flow has become better, profitability is better, cash flow is better, they are able to use cash accruals for funding part of their working capital. So corporate India's core need for banks to provide working capital is now getting leaner and leaner, one. Similarly, I think in those days, 50 years back, 100% of your term loans came from a bank. There was no other source. And your cash accruals were just not enough to... but today, cash accruals are mostly enough to meet your long-term needs, and everybody applauds it. And then you get to the capital market, either raising equity or bonds. So again, there is not a subtle shift, there is a clear shift away from a product which I would go to a bank to get a loan, a term loan or a working capital loan, to alternate sources, either my own cash accruals or money from through the capital market. So one strong customer base of yours, the corporate or the wholesale part of it, is today getting out of the picture. So you are left with retail. So what I think every financial sector player has to do is to understand which customer segment are we catering to, and what do we need to do internally to cater to that segment. So am I competing well enough in the segment that I think is open to me? Because some segments may not be that open to you. And today, to me, for a bank, let us look at the construct of a bank's deposit structure. It is primarily, it used to be CA, SA and fixed deposits. And CA was free, SA you paid a nominal interest, and fixed deposits you paid some interest. Your average tenor of your liability side is 1 year. So honestly, anything more than 1 year, you have to create term transformation. So to me, the the retail side then becomes the right sort of products for a bank to provide. And they have a strong competitive hold. And of course, you've got a regulatory, I would say, a regulatory moat. The regulator, trusts the banks. They would want the customer to trust the banks and so on. So I would think going forward, you will see banks increasingly look to the retail customer. And there's good news here, because the retail customer has now become an aspirant. The retail customer has money, is savings, he's looking for products. He started 20, 25 years back. Money to buy a loan to buy a motorcycle, a car, a home, things to put into the home. That continues now at an accelerated pace. So there is a large market. So I wouldn't say that it's any serious challenge for banks, but there's a challenge in repositioning yourself and in a way maybe reinventing yourself.
Yeah, I'm coming to that, the segments of customers and all. But before that, do you see actually India is going, because everybody is talking about 2047, Viksit Bharat, the growth in economy and so many aspirations and all. And at the same time, we talk about, in fact, Mr. Nagaraju, DFS Secretary, also talking about, look at our credit to GDP ratio so low, etc. But do you think actually in this new structure, we are heading into, going towards the developed markets way where the banking industry is one of the sources, market is emerging as a bigger or equally important source for corporate India for funds?
Yeah, let me put it in context. As you go towards Viksit Bharat, and I am clearly of the opinion that we will actually achieve our objectives and grow at a high rate of GDP growth every year for the next 22, 23 years. So, and you need to look back and see what happened when in other large economies, as a country started growing, what happened, which industry grew the fastest. So as momentum of growth increases, the first industry to bulk up and grow in size is the banking industry. You can look at Japan, 1970 to 1990, China, 2000 to 2015. So the banks were the ones which grew the biggest and the quickest. In India, I would think it is not only the banks, it's the entire financial system which will grow at this pace and grow the fastest. So we will see interesting change happening, and banks certainly will be at the forefront, at least in the immediate future, along with the capital market players.
Mr. Kamath, there's a puzzle I've not been able to understand or solve. Now, of late, because there is every day in newspaper media, we see that number of IPOs going, people are getting into money and all, is that look, this is why the bank deposits are not growing, it's just getting into double digit, has got into that now, but it's the corporate India and people are actually raising money from the market. But if you look at the fine print, I was going through it, I think 60-65% of the money is actually offer for sale. They are pocketing the money, it's not for investment at all. So I refuse to believe that the corporate India is raising money from the market instead of banks. Corporate India, whatever that means, is actually just encashing their value. So what's happening, sir?
Well, we need to look at this whole evolution that you are mentioning as in the context of the larger the growth paradigm in the country. Because if a company is generating enough cash and that cash flow is meeting its growth needs, and thereafter it is taking the company public, I think honestly that's a good thing, because you are putting it on a proper governance structure. And in that, if existing promoters dilute some of their own holding, I don't see anything wrong in that, unless somebody says there was something else behind it, which I am not seeing at all at this point in time. These are companies which have started to earn profits at a level which they did not do earlier. They have cleaned themselves up. They are coming into the marketplace and diluting some part of the promoters' holding and growing. I would think this will be the way of the future.
Okay, sir. Coming back to the mix of business that you are talking about and how the banks need to relook. See, the retail loans, dominantly NBFCs are there. corporates are all cash surplus. They are only coming to banks, if at all, for working capital, not for investment. Reasons are different. Infrastructure loans, banks are not capable of because of threat of asset liability mismatches, you yourself said. So which means I've left out agri, SME and small loans, and people believe they're all over leveraged. What corporate India was there a decade back, in that segment is heading towards that. So where is the core competence of banks to create new thing? If it's a retail loan, is that so? And is other banks, do they have the core competence to understand? And because these days customers are looking for the ease of business, kind of thing and all.
Yeah.
So does the banking system need to have a sort of soul searching to change the business model?
No, I think you painted a picture which the banks will face if they don't, in a way, reinvent themselves. Because if the customer doesn't want to borrow from you for whatever reason, there is very little you can do. So the corporate side, that's going to only accelerate as we go along. On the retail side, it is not that the customer doesn't want money from you. The customer wants money from a bank. The question here is, you mentioned the borrower is going more to NBFCs and so on. The question here is, how are you competing with the NBFCs? Because you have all the competitive tools, you as a bank. The NBFC sector cannot match your cost of funds. And that still is, the regulator has put a moat around it, so others can't take it away. So you have the money with you. You need to figure out how is it that you will put it to productive use. So if you have to reinvent yourself in the bargain, you will have to reinvent yourself in the bargain. And here, reinvention is not, a hugely difficult task. With technology as available today, you can reinvent yourself pretty quickly. The question is, will you, and how quickly will you do it?
Sir, so technology and the ease of business. So we all talk about UPI, and that's a phenomenal story. It's a global story everywhere. I mean, across the globe. I think there's not too many instruments which can compete with UPI. Phenomenal story. But if you look at the digital banking per se, when you say quote unquote digital banking, say Brazil's new bank is the largest digital bank in Latin America, and it's growing a major global player now. It was founded, I think, 2013. It's about 12 years. It's a great bank. UK's Revolut, doing extremely well. Then China's MyBank. You had an experience of China, you were there and all. So China's MyBank has phenomenal customer base. Ant Group is the promoter of that. Alibaba and Group and all. So where are we? I mean, here we talk about digitization, yes, fine. But why aren't digital bank, quote unquote, like MyBank, like Brazil's new bank, or like Revolut coming up in India? Is RBI not welcoming kind of stuff, or what is the problem?
No, I just want to put these three banks in context so that the audience, appreciates what's happening out in the outside world.
Sure.
These three banks are new banks. They are not established banks, and they've all gone head to head against established
and the
banks.
number of customers are maybe 1% of the. Sorry, number of employees are not even 1% of number of customers.
We'll put, let's say, if you put MyBank into context, MyBank has got 400 million customers, and employs 4,000 people.
Exactly.
So that's the scale of disruption that you can do with technology. So the question that comes is, and so far, nothing prevents incumbent banks in India from reinventing themselves to become like these banks. So you will have to, you now have what I call established case studies elsewhere, where a quote-unquote fintech, what we call a fintech, has set up a bank and has grown to this scale. It's already established, so why can't we do it through a bank which is already well-known, branded and so on, provide the same services and grow? So to me, I don't look at it as a lost opportunity. The opportunity is still there. We need to reposition ourselves to take that opportunity.
So
We meaning the banks.
Fintechs are there in the NBFC space. But
Fintechs, since they are not by and large deposit taking, They can't compete with the banks. So in India, you have got a natural barrier to competition. So I think for an Indian bank, actually, as of now, the cards are still with them. But will they play the cards properly is the question mark. Will they reinvent themselves?
Do you think RBI should encourage, then for the new licenses,
No,
pure
it's not.
play
It's,
digital
it-
bank
see,
coming
we are,
up?
we, are, we, are, we are talking of existing banks. They are large, profitable. They have got great capital adequacy ratio. So and known brands. I would say that they need to reinvent themselves. And to reinvent themselves, I don't think they need regulatory support at all. This is entirely in their hands. This is not in the hands of a regulator to tell you how you reinvent yourself.
And all talk about technology, are we investing enough? Do you see the Indian banking system investing enough in technology? Or
I
is
made
it just a lip service?
I made a statement somewhere else, I can make that again, so it's second-hand statement. I said Indian banks probably are investing too much, but they are not investing in right technology.
Huh?
What
What's
you're
that?
investing is the same old thing. You need to invest for today. So again, I don't want to go down this road, but each bank has to question itself: Am I, investing for today? Am I investing the way a fintech is investing or a digital player is investing? So that question, when you answer, you will know that I am either reinventing myself or not reinventing myself.
So one related thing, and you from various forum, you have been talking about data, right? Technology and data. Data can do everything and all. So look at our even the entities which follow the credit score and all. So if how much money I have taken, how much I am earning, and whether I am regular in repayment, etc., they've been caught. But if you see globally, again in China, in some of the other countries and all, there are multiple other factors get into that. Like if I am a habitual latecomer in office, right? So it becomes a negative factor because I may lose my job. Or if I have been intercepted by traffic police quite often, or my license was seized sometimes and all. These also get into the assessment of data and a person's creditworthiness. But in India, we're talking about so much of technology, etc., but we follow the same old rule. Do you think there's a change we need to do that?
I think that confluence is starting to happen. I think our credit scoring companies now are getting clearly up the curve. They've also seen what's happening elsewhere. There could be certain regulatory constraints. There could be, data privacy constraints. One will have to operate within all these constraints. But clearly, these other metrics are being, thought of, and I can't see them not being used in the next 3 to 4 years, so that your ability to, lend to a customer at the appropriate price becomes clearer and easier, rather than you do a lottery and either charge him too high or too low, and then you lose money and so on. So your predictability on the customer's ability to repay using what we call secondary and tertiary data. Not primary data is your financial data, but secondary data and tertiary data are other data points that you used. So other countries have used it. So within our data privacy construct, we'll have to see whether whether we can and how to use these.
One more related question, Mr. Kamath. People often say that all this technology, AI, etc., the biggest beneficiaries are the scamsters, not the users. And what they say is this, because there is always a human interface when it comes to finance and all. So like, look at Digi Yatra. I book a ticket wherever I want to go, and on my mobile I do this, and I don't need to say anything on Bombay Airport. My face is shown, and that's how it's done. But this cannot be done when it comes to finance and banking. There has to be an human interface, and there it creates a problem. And people are saying that, look, we'll get some benefit, the customers and the banking industry and all, but the biggest beneficiaries are the scamsters.
Yeah,
Is there any-
Tamal, I think scamster takes advantage of an imperfection. So your Digi Yatra, you are so comfortable doing it because there is no imperfection in it. It's straight through to the end. So wherever there is an imperfection that comes in, there is somebody who will do it. And I can tell you that This is nothing new in the banking business. We have seen this going back when we started our credit card business, how scammers should be. And then I had a chat with one of the, either Visa or MasterCard, I don't remember. And they said, we keep innovating how to stop scamsters. It takes a scamster only 6 months to overcome it. Because it's a physical intervention that you did. The scamster figures out how to actually overcome that and then games you. So ultimately, the answer is everything completely straight through. Having said that, in the digital world today, we will have to be vigilant all the time. The bank will have to be vigilant. We as customers will have to be vigilant because we do not know when, what type of a new scam could happen.